20s. Sir, we cordially invite you to to today's session. And without any further delay, I would hand over the mic to you to give us your valuable insights. Over to you, sir.
Thanks, Mehak. Thanks for the introduction. Hi everyone. Welcome to today's session. So without wasting any time, I'll start with the session. So let me just give a brief introduction about the session. This session is going to be about how you should be investing, how you should be allocating your money in your 20s. And by starting in 20s, how can you differentiate your portfolio like never before? So starting at 30, 31, 33 can make a lot of difference vis-a-vis starting at 21, 22, 23, which I believe is the age bracket of most of you listening over here. So as the heading suggests, that invest well in your 20s or work till you die. That is exactly what I mean by saying it. It's really in the literal sense. I would say that if you don't invest well in your 20s, you are destined to work till you die. In most likely circumstances, unless and otherwise you turn around in your 30s or 40s. So I'll just start with some basic principles some basic principles of investing in yourself, investing in where to invest and how to take risk and all and everything. And I would like to keep it an interactive session. So please keep on writing in the chat box if you have any questions or any inputs. I'll be asking a few questions so that we can make the most out of this session of 40-50 minutes. So the first principle, which I believe is you should invest the most in your own self, because if you don't invest in your own self, where will you get the capital in the first place to invest in the stock markets? So the first point of investing in any platform is to get the capital. And the first thing that you should focus on is building a good capital size. Otherwise, a small capital size that you might get out of your stipends or pocket money won't really make a big compounding difference in the long run as well. But if you invest well in yourself, if you get good degrees from good colleges and do an MBA or a chartered accountancy course or whatever you do, or invest in your business, this can really help you build and generate a good amount of capital. So the first focus should be on your education and skills. So if you're into your job, then give your whole hearted efforts to that job, learn on the job skills that are required, that you need to learn, and take more and more courses or learn from YouTube and other sources. There's so much of, there's so many resources online available for free that you need not even pay for. And if you can understand those things, then it's going to be very good. But don't worry, this is not going to be any kind of, I'll come to that. So don't worry, it is not going to be any kind of a philosophical session as I just started with the slide. It's definitely going to be on investing only and how you should be investing. So I'll move on to the next slide. So that is around not taking the risk is the biggest risk. So इसको अगर हिंदी में translate करें तो ये कौन सी series का web series का dialogue है? I would like to know from you all in the chat box. Fair enough. Yes. So everyone is right. Risk hai to ishq hai. So the decent way of saying is not taking risk is the biggest risk. Yes, it's from Scam 1992. Because you see, if you do not take any kind of risk, do you remember what was the price of petrol 6 months ago before the second lockdown was announced? Can I have the answers in the chat box? I guess lesser than that, Aniket. 85 to 90. I guess it's, yes, maybe somewhere in the range of 75, not 60. So it was somewhere around in the range of 75 to 80. And today what is it in Delhi? If I talk about, it's around 110. So that's more than 50% inflation in transport costs. So this transport cost is reflected in all the kind of commodities that we have to use in our day-to-day lives. So while the headline inflation that we know, consumer price inflation, etc., is 7%, But technically, if we see, the things are getting out of our pockets very faster than 7%. So if you guys go and buy the groceries yourself, you would realize how the prices of basic vegetables and fruits have also skyrocketed, and other commodities. So I very closely follow the results of many stock market listed companies, and mostly all of them in many of the segments have reported significant decline in their profit margins, and that is because of inflation. And now they're talking about passing on that kind of inflationary pressure to their customers. So whatever you are buying, maybe an HUL product or maybe an ITC product, that's tend to get expensive. If not expensive, they'll decrease the quantity. So one or the other way, it's going to get expensive. So what is the interest rate on FDs, which is the favorite instrument of our parents, the generation of our parents and our grandparents? What is the interest rate on FDs? Can anyone tell me over here? Or 5.3, 4.65. Great, great. So if someone can tell me at what rate is interest on FD taxable? Okay, I can't see answers, but I can say it falls as per, yes. So Michelle said it's as per slab. Perfect, Rashi. So I am assuming you are earning more than 10 lakhs. If you're earning more than 10 lakhs, it's going to fall in the 30% tax slab. So technically, even if it's 6.5% or 7%, if you adjust it post inflation, then it's just 4.5%. Post tax, then it's just 4.5. And technically, it's a short way of getting poorer day by day if you keep on investing in such instruments like FDs. So in my personal opinion, you should look out. This is uh, the biggest pullback that you should see, and you should move from uh, from at least FDs and bonds. They are really very tax inefficient mechanisms of making investments. I agree. There are many safe instruments like PPF and endowment policies, but that should constitute a very small part of your portfolio, and especially when you are in your 20s. Like for in my case, if you take my example, then it's around 5 to 10% in PPF, and I haven't invested a single penny in bonds. And if you talk about my father, it's even less than 5%. He has over 35 years of experience in the stock markets. So he is very much inclined into real estate and stocks. So I'll try and use his experience and transfer it to you the way it has been transferred to me. So you can marry either of the following things, either equities and cryptos in your 20s, or you can marry home loans and personal loans. So while you say that, if you take home loans, then you're building an asset, but that's not true, because home, fine, it's an asset that saves you rental expense, but for 20 years you will be paying your EMIs, and you have fixed a certain amount of cash outflow every month. So that's a big challenge, right? If I give an example of rent over EMIs, then rents are around 15 to 25,000 for a 2 to 3 BHK in cities like Noida and Gurgaon. But if I talk about EMIs for similar houses, it's not anywhere not less than 50,000. So you can invest the additional amount. If you don't have a house of your own, you can invest this delta between your EMI and rent expense into markets, and you can build your own house within 15 to 20 years. You can do the maths, and I'm sure you will get a better number than that. And the rental yield on, if you talk about the rental income that you get on houses, is around 2 to 3% in Delhi NCR, if I talk specifically about the state. So uh, you see, if a house is worth say 2 to 3 CR, its rent is around 50 to 60,000. So that again translates into 2 to 3%. So that's not I don't believe that the real estate prices of flats are going to grow by a significant percentage. So in my personal opinion, home loans and taking personal loans are not a wise decision in your 20s. Don't commit this crime with your financial health. You will be abusing yourself financially if you do these things in your 20s. So if I talk about personal loans also, since we deal in loans also, and it's going against my business if I say that, but still it's fine. There are many people who come to us and say, I am going to get married, Kanan, I need some personal loan. Now, if you don't have that much of money, why do you want to spend? Why do you want to spend on people whom you might not even talk to for years after your marriage? So I don't believe, if you don't have that kind of money, don't go for it. And any kind of fancy phones which is worth lakhs of money, don't spend even your parents' hard-earned money on such phones. It's really not worth it. Just to show off in your friend circle and everything, it's not worth it. I still use a phone which is worth just 30,000, and I've been using it happily for 3 years, and I can happily use it for the next 3 years also. So this is coming to the next point is that you should live below your means. Again, carrying forward from the previous slide, if you so there's a very famous quote by Mr. Warren Buffett, and I'm sure you must be knowing him. Uh, he has said that if you spend money on things you do not need, very soon you won't have money for the things you need. So that's what I want to make a point here, that if you spend EMIs on your phones, on your car loans and everything like that, which you don't need at all, then then you're not going to have the money that you might need in the longer run. So live below your means and always stay protected by way of a term insurance and a health insurance. But please live below your means. I am sure you can live below your means at least in your 20s. Maybe after you have ventured out so much, you can explore life in a luxurious manner after your mid 30s. But I'm sure you can live your life in a very decent manner by living below your means in your 20s. And that's going to make a lot of difference. And I'll show you what kind of difference it makes in the short run. So who is Mr. Warren Buffett? If I may ask you, which company does he own the shares of, maximum shares? Can I have the answers in the chat box? Like, which company does he run, basically? Yes, who said Apple? Okay, so I'll say that Apple is, yes, Berkshire Apple is the correct answer. And Apple is basically his largest investment. So Berkshire Hathaway's portfolio consists around 41% of shares of Apple. So Apple is the largest investment of Berkshire Hathaway, but Mr. Warren Buffett owns Berkshire Hathaway. That's correct. And Berkshire Hathaway was around $400 back in 400. If I'm correct, then it was actually around $40 back in 1976, the share, and the share is around 450,000 US dollars. So, and can you believe what would be the rate of return that over these 40-50 years Berkshire Hathaway has got, the compounded rate? Can anyone tell me in the chat window? Then I'll tell you the rate of return. Yeah, 4 lakh US dollars. 20%, Aniket says. No. Anyone else? Not at all. Gun? Not at all, Shaurya. 27%. It's somewhere close. Lesser than 27. So I'll tell you, it's around 22 to 23% return that they have yielded to their shareholders, and it has grown from 40 to $400,000. That's almost 10,000x in 40 years. If you compound that investment by 22 to 23% over years on a regular basis. So that's the magic of compounding, and we'll be discussing about it more in length. So coming to the next point, have patience. So I have seen many friends that what is happening to the stock, this has crashed from the levels you told me, etc., etc., etc. Okay, so I'll just share my entire screen and show you a very interesting thing. How many of you are following Kotak Mahindra Bank's share? Okay, Shaurya, then Pratyush, can you tell me the level it is currently trading at? Not an issue, koi baat nahi. So, okay, yes, 2036, it's around that only. What I'll show you is, So, do you guys know about the housing bubble burst that burst in 2008? Someone is answering. Yeah. Yes, great. Lehman Brothers, great. Yeah. So it declared insolvency, and all the banks who had extreme exposure in housing sector, which all banks do have, crashed like anything. And if the banks crash, the economy crashes. If the US economy crashes, then basically it's called the mother market, and then other markets follow. So if you look at Kotak Mahindra Bank, uh, it was at around it made a high of 359.5. Now, there must have been someone who purchased shares of Kotak Mahindra Bank at 359.5. That's why we have that kind of level. Now, if that person would have, somewhere exited around here and never entered Kotak Bank, he would have made a negative return of around 67 to 70% within a year. Now, if you would have bought here 350 at 359.5 levels, you were supposed to stay patient till all the way for 5 years. But you see the growth trajectory of this stock, it has grown like anything at a pace of around 21% per annum. Since 2008, the highs of 2008 till today, it has grown at around that kind of level. So isn't it really wonderful that you had to stay patient without any returns for 5 years? And then ultimately it skyrocketed so much that you have around 22% returns, 20 to 22% returns year on year, which Berkshire Hathaway has given to its shareholders over 40 years. So the key is to stay patient. It's not a fixed deposit. Stock markets and crypto markets are not fixed deposits. And in my personal opinion, if the company is good, like Kotak Mahindra Bank was, then it's definitely going to be a very good bet for you to stay invested in these instruments. And if you have the money, you should have been accumulating this kind of stock all the way from here till here and here. And you should have been doing a sip in these kind of stocks, or maybe the mutual funds which had Kotak Mahindra Bank as a constituent of the portfolio. So these are my 2 cents on having patience. For maybe for 5 years you might not see any movement, but all of a sudden, boom! It gives great kind of return. So have I cherry picked Kotak Mahindra Bank? Is it the bank which has given the maximum kind of return? And I'm telling you that kind of example. Absolutely not. So uh, I'll tell you there's that n number of examples like Eicher Motor, Bajaj Finance, Bajaj Finserv, and in fact there's a list of over 20 stocks that I have apart from Kotak Mahindra Bank which have returned more than 25% CAGR in the last 10 years. So you just need to pick the right stocks, and these let me remind you, these are all constituents of Nifty. So all these stocks which I'm talking about, the other 20 stocks like Biocon, Kotak Bank, HDFC, not even HDFC Bank. HDFC Bank is also a very good stock which has returned over 20%. But I'm talking about the ones which have returned over 25%. And most of them are constituents of Nifty. I'm not talking about the 1,000 crore market cap company which grew to be 20,000 crore market cap companies. I'm not talking about them at all. So it's really a magical thing if you learn how to invest. And more importantly, I'll say that I'm learning, of course, I'll keep on learning. But the one thing that I've learned till now is that analysis is one thing and having patience is the more difficult part in stock markets. But it's really a wonderful mechanism of making money in the long run. So we are done with the principles for now. Can we have any questions till now? Do we have any questions till now? Any your 2 cents of the audience around having patience, because I don't see people patient at all these days. I myself wasn't maybe a year ago or 2 years ago. I read a lot, I spoke to many people, I heard many people in the last 2 years. I've been investing in the stock markets for the last 5 years, talking about entering a stock company at the talk about entering a stock or company at the time of IPO. Yes, definitely it can be a great bet if it turns good. Like if I talk about Infosys, 15,000 invested in Infosys at the time of IPO would have been 5 crore 83 lakhs today. Apart from apart from the dividends that you received from that company, definitely. So it's not just about understanding the IPO. Of course, the information available in the IPO document, that is DRHP or a red herring prospectus, whatever you call it, is not sufficient to conclude whether a company will do good in the long run or not. But definitely we can have a sense what is going to happen in the company for the next 2 to 3 years. Then you have to keep on tracking it. And similar is the case with Divis Labs. Divis Labs listed in around 2003, 2004, and 15,000 invested in Divis Labs IPO would have been around 90 to 93 lakhs apart from the dividends. But 15,000 invested in Reliance Power's IPO would have been almost zero today. So you need to track the stocks, understand the IPO from their offer documents and everything. So Arab, I think I've answered your question. If you have any follow-up questions, you can shoot. Tushar is asking how to read these company graphs. So if you're talking about the price movement, you do not need to study these graphs for long run. For short run, technical analysis is there, and there's more than sufficient material on the internet to learn technical analysis. I personally do not know technical analysis, and I completely rely on fundamental analysis for making my investments and portfolio, and even for my clients. So Tapish says, sir, do we need to legalize our money after we withdraw it? I didn't get your question. It's already legal money that goes into the Demat account and that comes out of it is of course legal. You need to pay taxes on it. But Paytm. So Paytm, okay, so I should be answering about this thing. Okay. So Paytm is what got listed at a valuation of $20 billion, and it was expected the way Zomato had boomed up and Nykaa had boomed up and even Policy Bazaar, it was expected by the promoters that it will boom in the similar fashion, but it did not. And in my personal opinion, yes, these companies can be a great turnaround story for the Indian tech industries, and I personally want them to succeed. But the pricing that they've decided to come for an IPO is something in which they have discounted every good possible thing that can happen in the future, and they're asking you to pay the price for it. So even if the stock appreciates, it would appreciate by the inflation rate or maybe a percentage or two notches above that, but not more than that if everything happens the way they have already reflected in the price. So in my personal opinion, I have not invested in a single tech company till date. Of course, I look at the gray market premium and everything while applying before the IPO. And I even made a good bet in Nykaa and exited. But for long-term portfolio, no, I haven't invested in any particular tech company right now. And talking about other IPOs these days, so IPOs coming in these bull markets are, taking the valuation of their peers, which is already very high in this bull market. So I am a bit cautious about the IPOs that are coming in this time period. So I might not stay invested for long, but definitely I pull out the listing gains and exit. Where Arab says thank you. Difference between preferred and common stock. So you need not don't know this. You will just need to buy common stocks. Basically, preferred stocks are preference stocks where you get a dividend in preference to the equity shareholders. And in case a company gets liquidated, you have your right before the equity shareholders, but even the debt holders do not get their complete right in insolvency cases. So there's not much of difference that you should be knowing at this level, but definitely you can learn about it at depth if you Google it. But Paytm done. Okay. Should we invest in NFT or cryptos in our 20s? So I was that kind of guy who used to call crypto and NFTs a scheme a few months back. But when I started reading about this technology a few months back, I was really, really impressed with the way the world is going to change, and I can really sense it in the way blockchain technology is being adopted by the world and the way it is. Definitely, the world will not remain the same 15 years down the line. So it's good that you embrace this technology with you. And cryptocurrencies are a way, maybe where you can allocate somewhere between 3 to 10% of your portfolio. I am just invested at 1% of my portfolio in cryptos right now. But I am researching more and more on it. So I've invested in Solana. This is not an investment advice, just that I'm invested in Solana, and I might put more money into Solana. It's already a blue chip coin. But the thing is that if you invest 10,000 in a cryptocurrency, of course, that depends on your portfolio size as well. The downside is just 10,000, but the upside is 100x, 1000x. That's the kind of returns cryptos have done. So focus on cryptos which are somewhere between the market cap of 50 million to 500 million, and which have the potential of growing into 10x, 100x companies. So this is my advice to you for cryptos and all. ATM should be invested in NFTs. Tell us on mutual fund mechanism. So mutual fund is basically okay. There are a lot many questions, I guess. So mm, what's the time right now? So yeah, I'll maybe take all the other questions after this mutual fund mechanism, after the session, after we are done with the session. So mutual fund are basically managed, basically you see, you can't track 30-40 companies at once. So there's a mutual fund manager who does that on your behalf. And if you invest say 1,000 rupees in a mutual fund, then he takes 1 to 2% of fees from you in for investing in equity funds. And that's how mutual funds work. So basically you put in 100,000 rupees, you can't buy 64 70 stocks out of those 1,000 rupees, but then millions of people who are investing into the mutual fund industry, and collectively that amount gets big. He collects that, the fund manager collects that money and invests in different stocks based on his analysis, and he charges a fees of around 1 to 2% for that. So I'm really sorry, I'll skip to the session because I don't think so I'll be able to complete it otherwise. I'll come after that to you. So have patience. Don't be a crybaby when the market's correct. So where and how much to invest? कहाँ पैसा लगाना चाहिए और कितना लगाना चाहिए? That's what we are going to discuss in the next slide. So basically it said that 100 minus your age should be in equities. I am a little inclined towards equity. So I have more than 75. So I am 24 right now. I have more than 76% of my portfolio invested in equities, but I should be reducing that exposure ideally. And so I guess you guys are 21-year-olds, 20-year-olds. So you should have at least 80% of your portfolio invested in equities. And as you start earning, follow this 100 minus age principle for equities, and 3 to 10% in cryptos, NFTs, and unlisted equities, because these are very volatile kind of investment vehicles. So I would say, and wait for the ordinance to come, wait for the bill to be tabled. I hope that cryptos won't be banned. That's what I'm contemplating also. But let's see what happens. So wait for 3 to 4 days, and then let's see what happens with the cryptos and everything. And in unlisted equities, because cryptos are very volatile, and unlisted equities can either go zero or boom, like something like Oyo or maybe Byju's or Paytm. If you would have analyzed that company is going to go public in the next 10 years. Otherwise, there are many examples which have gone zero and the shares are not sellable at all. Balance in PPF and debt in a tax efficient manner. Of course, when you will start earning taxes, you should be hiring a chartered accountant for tax advice, and they will help you in deciding what is the best suited mechanism for you, in either by way of PPF or debt. Coming forward, so I would say that if you is like we have already talked a lot about FDs, so keep investing in FDs and make sure you are getting poorer. And I've already shared significant light on that, because again, I'm repeating my point. Just get out of that comfort zone of investing in FDs. That it won't fetch you more than 4 to 5%, and returns post-tax inflation. Sorry, for 4 to 5% returns post-tax, and inflation is 7%, over 7%, far more than 7%. We have already discussed that. So don't invest in FDs at least in your 20s, or maximum 100 minus your age, and some portion in cryptos, equities, and unlisted equities and NFTs, and the balance in debt or FDs or something like that. But please, for God's sake, don't do that in your 20s, because even if you are at a zero net worth during your 30s, you can still turn around your life. But if you do not turn around your life, if you do not decide to turn around your life in your 20s, you're going to be broke till 60, most likely. So, like, why only equities? Why are we talking about so much about Indian markets? What we have heard about the Harshad Mehta scam, we have heard about the dot-com bubble. What happens? So we have already discussed that if you know how the art of choosing good companies and you have the right patience and the mindset, you are going to make money out of this market. And if I talk just about the index, just investing in the NFTs in the last, you see, 10 years has returned around about 13 to 14%. And if I talk since 1980, the Sensex has returned over 16 to 7, over 17%. In fact, it was 16.3 last time I checked. Sensex was at 55, 53,000. Now it's around 58, 59,000. Then the returns are around 17%. And fun fact, you get to pay interest on FDs and debt at 30%. That is your top slab rate. More than that, you would have surcharge. So effective tax rate, if you start earning a lot, it can go up to 43%. But if I talk about long-term equities, it's just 10% plus maximum 12%. So even if you are earning more than 5 crores, um, on debt and FD interest, you will be paying around 43% tax, and here you will be paying around 12% tax. So the choice is yours. There's a clear-cut arbitrage here if we talk about making saving taxes. And you see, most of the billionaires like Mr. Warren Buffett, Elon Musk, Jeff Bezos, they are geniuses when it comes to taxes. Google, Facebook, they've avoided hell lot of tax. I'm not saying that you should be avoiding taxes. You should definitely be paying it in the most honest manner, but you should also at the same time learn how to save taxes in the most efficient manner. And this is one way of making money. So I'll just give some examples now of some people, of three kind of people that, so let's say there's a reunion of Hansraj College, and there are three guys one who would have been invest. So all three of them were disciplined guys. Let me say that all three of those guys would have been very disciplined guys, and I'm going to talk about those guys. So let's say you start at the age of 23 to 25, when you would have been done with your MBA and everything, and you're earning 50,000 per month in hand salary. Of course, that's very low. So I've just kept a very conservative number over here. And I assume that your salary increases by 10%, and so does your investment. So if your salary is 50,000, you are putting at least 25,000 in equities, or maybe debt, or maybe mutual funds. So if your salary gets 55,000 next year, then you make sure that you are investing 27,500 in equities, bonds, or mutual funds. So let's talk about the risk averse bonds guy from Hansraj College, batch of 2022, who puts all his money in bonds, and his rate of interest maximum can be 7.2% post tax. 9% रिटर्न आती है, मतलब कोई अगर आप ट्रिपल ए बॉन्ड से भी नीचे अगर आप कोई लेते हो तो उसमें 7.2 से मतलब 9% ज्यादा रिटर्न नहीं आती. मैं मानता हूं कि आपका टैक्स रेट अगर 20% भी होगा, देन योर इफेक्टिव रेट ऑफ इंटरेस्ट वुड बी अराउंड 7.2%, नॉट मोर देन दैट. आई एम नॉट कंसीडरिंग 30% एट ऑल राइट नाउ. आई एम अज्यूमिंग 20% रहेगा. सो आपको इसमें 7.2% रिटर्न मिलेगी. The risk averse mutual fund guy, he says that, okay, I believe in India's growth story. India has grown a lot, and I will invest in mid caps and large cap mutual funds, and I expect a return of 16% for this guy for the next 20 to 30 years. And the risk taker stock guy, who actively, enterprisingly invests into stocks, researches about everything and like that. And I believe that making a return of 26% is not the most tough task. If he's the risk taker guy and he has the right mindset of patience and everything, you can earn 26%. So let's see what the difference is. So this is somehow your portfolio would look like after 20 years. Say if I talk about the first guy, the risk averse guy, if I talk about him, so his portfolio would be somewhere around 1.68 crores after tax. The risk-free mutual funds guy would earn 3.6 crores. ज़्यादा difference नहीं है. Okay, इसका हो गया 5.55 crores for the next 20 years. Let's say you meet for another reunion after 10 years. So see here, you would be aged somewhere around 40 to 45. And in the next reunion, you would be aged somewhere around 50 to 55. One thing. Second thing, if you start investing at 30, then this would be a portfolio at the age of 50 to 55. And the next portfolio that I'm going to discuss would be at the age of 60 to 65. So उतना तो कोई सोचता नहीं, बट मैं 50-55 की बात करता हूँ. तो ये 10 साल का डिफरेंस देखना कि कितना बड़ा बन जाता है if you start investing 10 years late. And आपने अभी शुरू कर दिया और कंपाउंडिंग इसकी देखो फिर कितनी तेजी से होती है. आगे देखते हैं. सो पोर्टफोलियो आफ्टर 30 years, डेट वाले बंदे का होगा एट अराउंड 5.8 CR, म्यूचुअल फंड वाले का होगा 20 CR के आसपास, और स्टॉक टेकर रिस्क टेकर का होगा अराउंड 40 CR. So this is the kind of magic that you can see of compounding for an extra decade. Now that you have heard me, you are gonna promise me that you're going to be very serious about investing, explore different kind of investments and learn about investments. Okay, I can completely understand that. I come from a background where I have been learning stock market since my teenage days. And so you can maybe start investing a larger amount of your capital into good mutual funds and take a small part of your capital and invest it in direct equities. Learn it for good 3 to 5 years. And when you think you have got that art, then start investing more in direct equities and lesser in mutual funds. So if you think that you can earn more by investing more time in your business or your job, then go with mutual funds and don't invest your time in direct stocks. Of course, that's a very time-taking exercise, but I personally love doing it. So I've, I'm doing other businesses also, but I would rather analyze stocks for myself and clients rather than doing my job. So that was my case. That's why I left my job and I'm doing other businesses apart from this one. And I track stocks very closely, very actively. So now choose your goals accordingly. कि अगर आपको 5 करोड़ ही चाहिए 60-65 की उम्र में या 50-55 की उम्र में, ठीक है, तो बॉन्ड्स में लगा लो, मिल ही जाएगी इतनी रिटर्न. वैसे रिटर्न कम होती जाएगी ओवर द इयर्स एज कंट्री डेवलप्स, बट ठीक है, अज्यूम कर लेते हैं अगर आपको इतने चाहिए 19.3 crore, something like that, then you have mutual funds with you. And if you want something like 26% and you want something like 40 CR, then there's only one option with you. So thank you for this session. Now we can have the questions. So Meg, would you like to take up from here?
Yes, sir.
Yeah.
Sir, so if anyone has any doubt, so they can post it in the chat box.
Yeah, so I
So,
just read a chat that what if they have to ask me questions. So there's a group, I believe, that you guys have made, and we can choose on keeping it active, and we can have all the questions and queries over there. I will really try my best to resolve your doubts if you have any.
all right. So, sir, on behalf of the Professional Development Department, I take the opportunity to thank you for taking out time from your busy schedule and enlightening us about the important facts for investing in our 20s. Thank you so much, sir, and thank you all for joining us, and wish you a peaceful day ahead.
So yeah, maybe I can take up the questions now that have been lined up so far. What's the value of your portfolio? That's a confidential question. And so I'll move on. Does being in debt reduces okay, I'll start from where I left when Srishti messaged me. Just a second. So for a call, Deepak asks that for a college student, what is the best technical analysis or fundamental keeping in mind as a call would not be having large capital? So yeah, that's what I answered in the next part of the presentation that you should be investing in mutual funds initially. And when, of course, you might not have a great capital right now, no one has in their student life. Even I didn't have. So, but still, you should have that habit of saving at least 50% of your income and investing it. And ideally, your investment goals should be such that you first have a saving target, which should at least be 50% unless you have more responsibilities. But in on an average, like I had no responsibilities, so I could save around 95% of my salary because I had no rents to pay, I had no groceries to incur cost on. But there are many people who can't even save around 5% of their salaries because they have responsibilities, not because they are spendthrifts. But on an average, I can assume it is around 50%. So at least try and save 50% of your salary, but by living within your means. ऐसा नहीं कि if you are able to save only 30%, तो जबरदस्ती you can't cut down on your necessities. और ऐसा नहीं है कि अगर 60-70% आप कर पा रहे हो तो उसको 50% ही करना है, बट एवरेज में मानता हूँ अगर 50% है तो उतना तो आगे करना है आपको, और अभी से आदत डालनी है वाली. तो अभी म्यूचुअल फंड्स में डालो, कीप ऑन लर्निंग, reading about stock markets daily, read economic times, and maybe after 1 year, if you have done through reading about all that economic times and stuff, you can shift to mint. It's a bit complex but more insightful than ET. So moving on to the next question. What about the what are these fundamentals that you're talking about? So while we are making a course on that, and we keep posting that on our Instagram channel at RupeeTool, RupeeTool, but it's basically checking the financial health of the company, and checking the financial health of the company, and what are the promoters doing, whether that industry is going to do good or not in the long run. Is small case better for beginners? Yes, you can consider that as well. Can you introduce us to ETFs? ETFs basically, जैसे if you talk about index fund, वही ETF होता है. उसमें कोई एक स्टॉक चला गया है, किसी एक स्टॉक का पार्ट इंडेक्स में बढ़ गया, सो ऑटोमेटिकली ETF उसको एडजस्ट कर लेता है. स्टार हेल्थ IPO, मैंने पर्सनली अभी इसको एनालाइज नहीं किया है, बट इसका ग्रे मार्केट प्रीमियम देख के ऐसा लग रहा है कि इसकी वैल्यूएशन थोड़ी एक्सपेंसिव होगी. तो I won't be putting my money into Star Health IPO. Does MBA plays an important role in such career? What kind of career? If you're talking about investing career, then not necessarily, but yes, it definitely adds an edge. How do you anticipate that a company's share will be giving good returns? So I check that whether that industry is going to do good or not, what is the past performance of that company, whether it is planning for any expansion. And I do all that modeling kind of thing, whether this company will be able to do good with with its expansion plans or not. And I take a bet according to that. But now the cryptocurrency bill will be introduced next year, within this year only. And what next year? Let's see what happens. Which is good. So that's why I say don't invest, since crypto is an unregulated market and stocks are regulated. So don't put more than, I won't put more than 3% of my capital at all. In not never in my right mind I'll do that. But people are doing up to 10%. And the wise people I know. So maybe you can take it up to somewhere between 3 to 10% as well. But I won't personally do it for more than 3%. Which is good, mutual fund or small case? Well, that will again constitute an advice. But if you don't have to apply your mind at all, then for long term Nifty 50 ETF is good. What is your take on restrictions that RBI is planning to impose on crypto? Like, let's see what the bill says. My take won't really matter because whatever the bill would say will hold true. Yuvraj is asking, good to invest in FMCG stocks right now. I believe they have been beaten maybe more than what they should have been because of the margins contraction. But you can check it for yourself. I am not invested in any FMCG company right now. But you know the famous names and the blue chip funds. You can check for yourself and read what are the analysts saying for that particular stock. Which graduation degree would be good if someone wants to make a career in stock markets and technical analysis? So CA, CFA, MBA, either of these 3 degrees. Invest in penny stock is good, not at all. So in a universe of 5,000 stocks, when you have good stocks, 1,000 stocks to choose for your portfolio, and I don't think so you can choose more than 20 stocks. So rather study and make investment in good stocks. Like I'm saying, people are investing in Vodafone Idea and Yes Bank. I have no grudges against them. It might boom up, but why to invest in such stocks which have really poor fundamentals when you have other 5,000 options to choose from? And there are many stocks which can do provide much better return than you're anticipating in these stocks. And you just need to have that kind of hardworking attitude also to find these stocks, of course. But in I will never personally invest in any penny stock as a beginner. How do we decide which company and which sector to invest in? So as a beginner you won't be able to decide. First of all, that's why I said start investing in blue chip and mid cap mutual funds or ETFs, and start learning about stock markets slowly and slowly. And maybe in the next 3 to 5 years you will really learn what happens and what doesn't happen after observing it for these many years. And then maybe you can get that kind of confidence. What about gold? I'm not personally invested, but it is considered a good form of investment, a defensive form of investment, which is traditionally provided on a longer term around a CAGR of 10%. So it's a defensive way. So when there's a crisis situation, gold, gold is a good bet, I would say. What else should I consider before investing for a beginner? So I think we have already touched based upon that. The ratio should be good within the limit. The sales growth should be good as compared to the peers. The industry should be right. It should not be a sunset industry like the newspaper industry is a sunset industry. So there's no sense putting your money in a newspaper company, or maybe so these are kind of sunset industries. Don't put your money in. Talking about the sunrise industries, EV and all, but then you need to check the valuations as well. So these are the things you should see apart from numbers. Does being in debt reduces taxes? So it reduces the interest liability reduces your income, but that's only for business professionals, not for you. And the debt should also be taken for business purpose. So that doesn't reduce your tax liability per se. And if you take a home loan, yes, you can reduce your income by 2 lakhs, but that saves you tax of around 50 to 60,000. But you can make more money than that by investing in mutual funds, I believe. Is inflammation included? Inflation. I don't know what are you talking about, Aniket. Where is it included? Aryan is asking. Okay, this is a repeat question. How to contact you? So Bhavya, I think we have already answered that. You can we can chat in the group. In that group, I'm a part of that group. How do you analyze a company before investing? So I think again I've answered that. Again, that's what's the value of your portfolio? Again, that's a repeat question, Deepak. Aryan is as sovereign gold bonds. I personally think if you have to invest in golds at all, then sovereign gold bonds are better because it yields 2% interest as well. I can't say that whether it's going to be good in than FD. But if you have to invest in gold, then gold alone is also better than FD. But if you have to invest in gold, invest in SGBs because conversion charges are not there, and any kind of hera fairy that the jewelers can do, that can't happen at all in SGBs, and you get 2%, 2.5% interest as well. So historically, yes, SGBs have been better than FDs. So what is bond? Bond is a kind of loan. Okay. And would getting into futures and options? No, not at all. Not at all. First, focus on fundamentals. Invest a very small part of your capital in futures and options, and you will realize why I was right. Good to invest in FMCG companies right now. Again, that's a repeat question. Is investments in yes, Lenovo. Is investments in MF better for beginners? Yes. Sir, I'm a CA student and I don't get time to maintain study and financial learning. Do suggest something. So, Srishti, at this stage, if you're a CA student, I have myself been a CA student for 4 years. So I would say that don't focus on stock markets. When I had gone for study leaves after my articleship to give my exams, I liquidated my portfolio because the kind of return becoming a CA gave me, maybe a 50,000 or 1 lakh of capital would have never given me till date. The capital that I've earned from salaries. So don't focus on stock markets at all. Uh, just read economic times and follow what's happening in the financial world. Nothing apart from that. Please stay away from that. First and foremost rule is to invest in your studies, invest in yourself, and then come to stock markets. I think, okay, this is a repeat. Should we first take life, health, insurance, emergency fund, and then invest? Yes, Abhishek, that's a good point. So we are not discussing personal finance here, but this session was around investing. But personal finance says that first you should have your term insurance, health insurance, emergency fund, and then you should start investing. That's correct. Should we go for index fund? Yes, you can. What strategy should one use in swing trades? I don't do swing trading. I can't suggest that. And as a student, you should also not be focusing on trading and all. Focus on investing and and being good at your own craft. So work on your own craft and ये swing trading chart but इस पे focus मत करो अभी. Okay. Beginners should invest in blue chip. I think we have covered that again. Then okay. So I think we are done with the questions.
Can you please give a chance to yeah, sir.
Yeah, so I think we can have rest of the questions in the group itself. I'll put the group link in the chat, and if some of you are not there in the group, and we can have questions in the group itself. Thank you, Kanan, for your time. And it was an amazing session, and hope everybody liked it. And thank you all for joining.
Thank you. Have a nice day, everyone.